All right, let's dive into a really big idea in the world of international tax. It's built on something we can all understand: fairness. It's called the non-discrimination principle, and it's all about making sure that whether you're a person working abroad or a huge company, you get a fair shake. So let's break down what that really means in practice. I mean, just think about it for a second. What if you were charged more for something or given fewer chances just because of where you're from? It feels totally wrong, doesn't it? Well, that's the exact problem the global tax system is trying to solve with this whole principle of non-discrimination. Let's put this in super simple terms. Imagine a university charging a foreign student $3,000 for tuition, while a local student pays only $1,000 for the exact same classes. We'd all look at that and say, no way, that's not fair. Tax discrimination works on that exact same idea. A country just can't penalize you because you're not from there. So you might be wondering, why do countries even sign up for this? Well, it's all about building a thriving, interconnected global economy. Through tax treaties, nations basically make a promise to each other. They say, hey, come invest in our country, build your businesses here, create jobs for our people, and we promise we'll treat you fairly. Without that promise, that guarantee of equal treatment, global investment would just dry up, and that would hurt absolutely everyone. Okay, so how is this promise of fairness actually put into practice? It's not just a handshake and a smile, you know? It's actually written down in most international tax treaties, specifically under Article 24, which lays out 5 very specific rules. Let's walk through each one of them. First step, rule number 1, nationality. This one's the big one, the absolute bedrock of the whole principle. All it says is that a country can't charge you more in taxes just because of the passport you carry. If you're a foreigner living and working in that country and you're in the same boat as a local citizen, you've got to be taxed the same way, period. Let me give you a really clear example. Let's say we have John, who is a citizen of Ghana, and Pierre, who is a citizen of France. They both live in France, they both work in France, and they both earn the exact same salary. Now, if France decided to tax John at a higher rate just because he's Ghanaian, well, that would be a total violation of the rule. The key here is same circumstances, same tax treatment. The second rule provides a really critical safety net for a group of people in a very vulnerable position, stateless persons. We're talking about individuals who don't have a legal nationality in any country. This rule makes sure they don't fall through the cracks and get hit with unfair taxes. Basically, what it means is that if a stateless person is a resident of a country, that country can't slap them with harsher taxes than it would its own nationals. It's a fundamental protection against being punished for a situation that is almost always completely out of your control. Okay, now the next rule deals with businesses, so we need to quickly get our heads around a key concept. It's called a permanent establishment, or PE for short. Don't let the name scare you, it's pretty simple. It's just a fixed place of business, like a foreign company's branch office, or a factory or a workshop located in another country. And that brings us right to rule number 3, which is all about that PE we just talked about. It says that a foreign company's local branch, its PE, cannot be taxed more harshly than a local company that's doing the exact same kind of business. It's all about creating a level playing field. So, for instance, if a local company in Ghana pays a 25% tax rate, the government can't just turn around and charge the Ghanaian branch of a UK company 35% on the same kind of profits. Foreign branches have to be treated like equals, not like some kind of second-class business. All right, on to rule number 4. This one gets into the real nitty-gritty of running a business: deductions. So when a company has expenses, like paying interest on a loan, it can usually deduct that cost to lower its taxable income. This rule says you can't deny that deduction just because the payment is going to a foreigner. So denying a company a tax deduction for interest it paid to a foreign bank while you allow the exact same deduction for interest paid to a local bank, that is a textbook example of discrimination. The business expense is the same. Where the bank is located shouldn't change the tax result. Now, there is a super important exception here, a big but. Countries are allowed to have rules to stop tax avoidance. For example, they can have rules to prevent companies from loading up on debt from a related foreign company to shift profits out of the country. The absolute key, though, is that those anti-avoidance rules have to apply to everyone, payments to locals and foreigners alike. And that brings us to our 5th and final rule, which protects the company itself. This one makes sure that a local company can't be hit with higher taxes for one simple reason, because its owners or shareholders happen to be foreigners. So think about it. You've got 2 local companies, Company A and Company B. They're in the same business, in the same country, making the same profit.
The only difference? Company A is owned by locals, and Company B is owned by foreigners. Taxing Company B at a higher rate is pure discrimination based on ownership, and that is exactly what this rule forbids.
So we've gone through what Article 24 does. But to really understand it, it's just as important to be clear on what it doesn't do. So let's take a look at the limits. And this is the crucial takeaway. This is a rule for non-discrimination, not a rule for getting better treatment. It doesn't mean a foreigner gets special perks. And it also doesn't mean that if a country gives a really sweet, low tax rate to one specific treaty partner, it suddenly has to give that same amazing deal to every other country in the world. It's about equal treatment, not best treatment. All right, now for the million-dollar question. These rules are great in theory, but what happens if a country actually breaks them? What can a person or a company do to make things right? And this is where it all becomes very real. This isn't some abstract legal theory. We're talking about protecting a Ghanaian engineer who's working in Canada. It ensures she's not hit with a higher tax bill than her Canadian colleague doing the same job for the same pay just because of her nationality. This is about people's real lives and their money. Luckily, there's a process to fix it. It's called the Mutual Agreement Procedure, or MAP for short. And it's actually pretty straightforward. The person or company facing the discrimination can go to their home country's tax authority, or even the tax authority in the country where the unfair tax is happening. After that, the two governments are required to get on the phone, talk to each other, and figure out a way to resolve the problem.
So at the end of the day, this non-discrimination principle is so much more than just a tax rule. It's a promise, really. It's the promise that holds up our global economy. And it relies on countries holding each other accountable and on people and businesses knowing their rights. Which kind of leaves us with one last big question. In such a complicated world, how do we make sure this incredibly important promise is always kept?